Okay, let's take a look at Apple. Apple, I'm gonna take a look at the day. So, let's say for example, you bought Apple back in late August, early September, $238. You basically had a hundred. Today is trading at $334. You basically had $100 gain per hundred shares of stock. So, but you're a little concerned on your investment, and you want to be able to protect your investment on the downside, and limit your risk to the upside. So let's take a look at the option is one of the great ways to hedge your investment. So I'm gonna take a look at the um, January 2011 options. Options usually trade 30 days in front. So you could either do the January, you could do the February 2011, um, May 2000, March, April, or you could even do a leap up to 2013. But for this video demonstration, we're gonna do Apple January 2011, the $340 cost. So let's say, for example, you don't believe Apple is gonna move up beyond $340 in 16 days. So what you could do is sell the $340 contract, which basically means if Apple trades above 340, and let's say it shoots up to 400, you're obligated to sell the stock, 100 shares of stock at 340 dollars, but you collect the contract premium of 630, which is over here 600. If you were to sell Apple, 630. On the other hand, you can also buy a put to protect yourself on the downside. Basically, in other words, let's say you're concerned Apple dropping down to 300 for example. 300 for example. So what I would do is I would buy the $330 put, which costs $715. The contract will cost you, I'm sorry, $720. What basically that means, let's say Apple does trade down to $300 in 16 days. What it means, whoever that sold you or wrote you that contract has obligations of buying it at $330 strike. So, but it'll cost you 720. It'll cost you $720. So those are the two possible ways to hedge your Apple shares.